What's going on, guys? Brandon Gentile here, Legacy Group Real Estate Team. We have your macro Q&A. This week we have, why do I hate stocks? Why do you hate stocks? That's a question I get all the time, and we're going to answer it here now. And the truth is, I hate stocks because I actually don't hate stocks. They're just not the asset I would be in right now, and I'm not in right now. And there are a million different indicators as to why. If you watch our insiders reports, we've gone over them. We're going to go over them the next 5 months. If you saw our insiders report from this month, from last week, the next 5 months, we're literally going to go over cryptocurrency, precious metals, the everything bubble, which is everything from bonds, the stocks, the Warren Buffett indicator, Mike Maloney's stock fragility index. Everything is flashing red, yellow, red, whatever you want to call it. Massive warning signs, caution tape. It's going to be an interesting time ahead. Let's just say that. So I don't hate stocks. I don't discriminate what asset class there is. The biggest misconception, the thing we're told all of our lives, is that we have to diversify and make sure that we're in different places. That way, if something happens, that we have different allocation of our money and we're not all in one spot. But that is really the antithesis of what you want to do. You want to be in the asset classes that are undervalued. And I was just having this conversation this past weekend with one of my loved ones, and it was interesting because they come from a financial background and they tended to not agree with me. And that's totally fair. Everyone has to do their own homework. So I say all this, and I want everyone to go do their own homework, because that's exactly what needs to be done. Every person is different, and every person has different risk aversion. I am someone I'm not the smartest person in the world, don't claim to be, never will be, never have been. So I want to make sure I'm dummy proofing what I'm doing. And by cycles investing, which is actually what we'll right here first, by cycles investing, and again, I'm not smart enough to know if this is some type of stock thing. I don't know. Don't care. Don't think about it in terms of stocks. We have to start thinking outside of the box of stocks and paper. Paper is stocks, bonds, mutual funds, and that's what I'm going to put right here, the 4 asset classes. Does anyone know the 4 asset classes? We have paper, we have business, we have real estate, and we have commodities. So these are the 4 asset classes, and this is what needs to be your diversification in these different asset classes. Because when these things go up, generally, say paper and real estate go up, commodities are down. Business might be down, buying businesses, having a car wash, or whatever, what have you. This is kind of free floating, free ranging. It kind of does its own thing a lot of times, but usually these things are closely linked. Usually paper and real estate are closely linked. Commodities, so it might be gold, silver, oil, grain, wheat, corn. Those commodities are there. Those are usually inverse of what's going on with paper and real estate. And right now, and I've got something I want to read here it's literally from Realtor Magazine, so the national publication for realtors. And again, I feel it's my duty as a business owner, but also as a real estate agent and a business owner and having multiple businesses. It's my job to inform our clients, inform the public, inform people around me, my loved ones, whoever it may be, whoever will listen to me rant and rave, whoever will hear the sound of my voice and hopefully spark some interest, some intrigue, and that way someone else will want to go do homework and start looking at some of the things that I'm talking about, because this is what's plaguing us. And we have things like this article, which I'll read here in 1 second, that it's from Lawrence Yun, who I'm sure is an incredibly smart man, the NAR the National Association of Realtors, NAR chief economist. He's been doing this for a long time. I'm sure he's an incredibly smart man, like I said, but he says some things in here which are, some of them are true, but some of them I just quite frankly have to laugh at. And again, when you have these different classes, again, you have to see what's up and what is down. And we've gone through these in many different things. We have the ratios that we use. That's just one of the easiest ways, the ratios to see what's undervalued, what's overvalued. And the whole point of this is you want to find asset classes, and how you take the ratios when you're finding what's overvalued and what's undervalued. You're taking the Dow, say, in paper, so stocks, bonds, mutual funds, IRAs, 401ks. You're taking the Dow and you're dividing it by a medium priced home, but dividing it by an ounce of silver, an ounce of gold, and you're seeing these ratios and you can start to plot them. And when we plot them, that's when we find out over the course of time what's undervalued and overvalued. I could give you the ratios just because I know them, but the whole point is I want you to go do your homework and I want you to find out what they are, because me just telling you isn't going to do anything. For really quick, for instance, right now the most undervalued asset class is commodities, and the most undervalued asset in there, really, because gold and silver is true money, and silver is so undervalued compared to gold. So you have, not only is commodities or our commodities undervalued in general, you have silver within that class that is even more undervalued. It's 1/80th of gold. So it takes, for 1 ounce of gold, you can buy 80 pieces of silver, 80 ounces of silver. Usually that natural ratio is about 1:12, 1:15, 1:20. And just a few years ago, it was down to 1:30, 1:40. Then it's a really good time to buy gold. But we're at 1:80. That's incredible. I mean, silver is so undervalued. And eventually when these things crash or correct, which is natural, we go in 7 to 9 year cycles, right? We're in year 9. Well, when it goes up, gold and silver go up, always have, always will. This is what's going to happen. And again, you can add in crypto, because that really is, in essence, kind of a new asset class that's really kind of been created. But that's still, there are some interesting things we're going to get into later this year about that and do some really in-depth. I already have about 3 pages of notes that I've made. It's going to be probably one of our most in-depth insiders reports in a while. It's about 3 months from now. And so I've already been planning that, already doing that. But right now, this is for thousands and thousands of years, since the beginning of time. That's what people have been trading with and using, and it's still around and always will be. It's the safe haven asset. But I don't care. If this was, the market is exactly opposite, and these were very high, and these were fire sales, I would be talking about paper and real estate. That's the difference, and that's the thing that I think that, when I get into debates with people, I think they sometimes, I try to get them to realize I don't care. I might be talking about gold and silver right now, or I might be talking about one of these classes, but I don't care what asset class it is. If these are down, I want these things. So if those are down, this is most likely up. Well, then I want these things. I want paper and I want real estate. I want to be buying cash flowing real estate, rental real estate, when the market is crashed, commodities are way up. I want to sell off the gold and silver, at least a good portion of it, and transfer that money over into, or that currency, I should say, transfer it over into real estate, into cash flowing real estate, or maybe some incredible fire sales in the stock market with, say, an Apple or Walmart or whatever it may be. That is the whole point of this. That's the 4 asset classes, and that's why this is so important. And that's what cycles investing is. It's finding the undervalued asset class, not just one asset class, because again, everyone, what are we all told? Diversify for the long term. In stocks, bonds, mutual funds, IRAs, and 401ks, that's all the same asset class. Well, when the market goes down, all of those things go down. We saw that in 08. We saw that in 2000, in the dot-com crash in 01. We saw that in 08, 09. We saw it in Black Friday, or Black Monday. I'm getting all my days mixed up now, in 87. This cycle repeats, and we had one in the 90s as well. It just repeats over and over and over and over again. And in order to get out of that valuation channel, we need to start investing in the undervalued asset class instead of continually just stockpiling here and making money and then decreasing by 50%, and then making that gain back up, regaining that, and then losing it again 50%, and then gaining it again the next 8 years, and then losing it in a year, and then gaining. That pattern is that valuation channel that most people are stuck in. It's really, as Robert Kiyosaki says, that's the rat race. So I don't hate stocks. It's that I'm a value investor. I'm a cycles investor. That's what it is, and that's what I hope some of you can be, and some of you are. I know some of you are already. I just want to read this really quick, kind of finishing up here for today's quick Q&A. He talks about 5 million, and the unemployment rate is an absolute joke. It has been for years, probably since Reagan. It started getting shifted around, with the first Bush and then Clinton, and then George W. started messing with it a bit, and Obama really messed with it and skewed it to make it look good for them. Each president kind of did his own thing, and now you can't even trust it. There's the different rates. You can actually, when you go in and you look in the government website, you can actually see the different kinds of unemployment rates they calculate. You have to do your homework. It's really up in the teens somewhere. It's not, he's right here. 5 million net new jobs over the past 2 years, pushing the unemployment rate down to 3.8%, the lowest rate in 50 years. That's incredible. I don't, everyone, I don't see everyone with a job. There's people everywhere without jobs, full employment. More good news. Despite recent volatility, the stock market has been close to an all-time high, helping push the combined wealth in the U.S. across the 100 trillion mark for the first time. What does that mean? Is anyone truly wealthy? Newsflash, all the money that's being printed, all the currency being printed in the last 10 years, which have been printing massive amounts. That's why the stock market is so high, breaking all-time highs. We were at 14,000 when the market crashed in 08. We crashed down to about 6 and change, we'll say 6.5. We're now back up to 25,000. What has been truly accomplished in that time? If anyone can tell me what's truly been accomplished, that we all of a sudden we're breaking records here and now have just launched. We are almost double the stock market before we crashed in 08. So if someone has an amazing answer, please let us know. I don't know of anything. And again, pushing the combined wealth of the U.S. across the 100 trillion mark, it doesn't mean anything. Unless people took the money out of the market and made money from that, or took money out, that's the only thing it means. That doesn't mean anything. It's all paper. People are net worth millionaires or paper millionaires. It's because on paper they might be a millionaire, they might look like they're a millionaire, but they don't truly have that cash. They don't truly have that money. Just like this next stat, the median price home has risen 40% over the last 5 years and continues to climb. Again, what does that do for you? In order to take that money, you either have to have a HELOC or sell it. So if you're selling your home, you have to go buy something else. You got to go find something else in an overvalued market. Or you have a HELOC, which, again, maybe you have a decent rate on it, but then you're still using that. Really, the only thing you can do, the one good thing out of that is that you can use that HELOC to go buy cash flowing real estate to leverage yourself to buy assets. But a lot of people choose it to buy liabilities. They use that money, that HELOC, to go buy a new boat or a second home or a new car, and then it's another liability that they're having to pay off themselves instead of cash flowing real estate where they have renters who are paying off their loan for them. So that's the difference. And again, this is the stuff we talk about all the time in our insider reports. We get into real detail with this. We are printing astronomical amounts of money, and we have been. QE1, QE2, QE3, I think we were in QE4, I don't even remember now, to be honest with you, QE infinity. And this is why the cash is sitting on the bank's balance sheets. All the biggest banks in the world, all the biggest bankers, they run the world. Not heads of state, it's the bankers. The bankers run the world. Ever since 1913, the Fed was created. You can thank Woodrow Wilson for that. The income tax, the Federal Reserve, and we've lost 95% of our purchasing power of the dollar since then. In the last 100 years, 95% of our purchasing power. And that's, again, we all joke, Grandpa's house used to cost $5,000. Well, that's just inflation. That's just because our money is eroded. It doesn't mean that those things got more expensive, actually. It means our dollar is worth less. So that's why when you measure against gold or silver or things of value, then you start to see where true value lies. So again, doing your homework is the most important thing. And again, I try to throw up as many assets as I can on here and put links to these things as well, guys. I got a couple more things really quick. Home sales are down 1%, of course, because the homes are too expensive because there's no one building because costs are too much to get contractors to build because no one wants to do skilled labor, unfortunately. So it costs way too much. Homes aren't being built. So there's an inventory shortage. We got hedge funds, people buying up homes and sitting on them. So we have a huge inventory shortage across the country. And that means that prices go up First-time buyers can't buy. People can't sell their home. Take that 40% of the median house price, raising 40%. They can't take that equity out and go buy something else because they're jumping into this insane inventory shortage market. The number, it's incredible. The number of consumers strongly expressing it's a good time to buy fell 7%, almost 7% over the last year, of course, because they're seeing people get destroyed. They're seeing buyers have a heck of a time making multiple offers. Homes are going, 10, 20, 50, 100, in some markets, San Francisco, going hundreds of thousands of dollars over asking price. That is when you start to get worried. Warren Buffett always says, when people are getting greedy, that's when you get scared. And when other people are scared, that's when you get greedy. And that goes back to cycles investing. So when people are getting greedy, stocks, they're never going to go down. What do you mean? You always got to be in the market. Well, that's when you get scared. And you start thinking about other asset classes, because that's when generally things start to happen. And when people are scared, these things crash, and people are scared, that's usually when it's a good time to come in. And again, we've all heard of buy low, sell high, yet very few people do it. So that is our quick, why do you hate stocks? And I wanted to bring you guys that today because it's a question I'm often asked. I just had the conversation again this weekend, a fairly heated discussion about it this weekend, and it's something I'm very passionate about. And like I said, I feel like it's my job to present this to you, present a different way of thinking. And right, wrong, or indifferent, it's something that I do my homework on constantly. I want you to go do your homework because it's the only way that any of us can really go forward and have some control, some semblance of control in our life. Jim Rohn always says, it's one of my favorite quotes of all time. Jim Rohn is one of my favorites, personal development people of all time. And he always said, if you leave your government to manage your wealth, by the end of your life, you can divide your life earnings by 5. But if you take control of your wealth, by the end of your life, you can multiply your winnings, your earnings by 5. So it's always something that's stuck in my head, and I take it very seriously. And it's all the downtime that I do have, I'm trying to study and trying to get better so I can bring more information to you, so I can make more sound decisions for. And part of it, like I said, I feel is a true duty and responsibility to be in business still, and be in business in a year from now, and 5 years from now, and 50 years from now. That way I can continue serving, because it does no good if all of a sudden I'm giving you advice and then I'm out of business in a year, or I'm out of business in 5 years. I think that's something that I don't know if it's a skill. I don't even know if it's a skill. It's just the way I think. I think very long term, very 33 years down the road. That's how I'm thinking. I'm not thinking what's good tomorrow. And I really think it's my duty, because it doesn't look good, one, but it also doesn't do you or doesn't do anyone any good if we're in business and we're helping a bunch of clients and all of a sudden we're out of business in a month or out of business in a year. Well, now I'm leaving people high and dry. So I really feel it's my duty to inform my employees and the people around me. That way they can provide for our clients, and that way I can provide for them, and then we can take that message out to everyone around us. So I thank you for listening and your time, attention, energy, because we talk about assets all the time, but time truly is our most important and valuable asset. So I thank you for spending it here, and I'm humbled and honored to have it. So thank you guys, and we look forward to seeing you soon.